Hello, mates of Equity Mates. Or I guess that just makes you Equity Mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. We hate spam. It's once a week and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, where we help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make a return. My name is Bryce, and as always, I'm joined by the forever giggling Equity Mate, Ren. How are you going, bro?
I'm very good, mate. I'm very good. That is the giggling is the soundtrack to this podcast.
Anyway, so we are here for an Equity Mates first.
An Equity Mates first?
Yeah.
What is it?
We're having a guest on the show twice.
Wow.
I know, it's big. We've got Andrew Brown back on the show. He was our very first guest on the show way back in February or March last year. And if you haven't listened to it already, as we say in this episode, you must go and listen to it because it's a fantastic episode to listen to as a beginner. The way that he speaks is great. So we've come back to him and we got him back on the show. So this episode we discuss two main things. We look at some of the stocks that he recommended last episode to review the performance, and we also look at information flow and how he keeps on top of his information.
Yeah. So that's a big thing that we wanted to do with Andrew, and we want to do with our guests going forward is not only understand their investing journeys and how they got here, but also understand what their habits are, what their investing habits are, what these experts do to maintain their edge, I guess. And so in particular, in this episode, we asked about how he manages information, what information he reads, and what his typical day looks like at age 72. But before that, we recap the last episode, and surprisingly, he picked a lot of out there stocks, and they all seem to do pretty well.
Yeah.
Yeah, he did. There's a reason he's an expert, shall we say.
Yeah. So yeah, this is a great one. You're going to definitely get a lot of key takeaways from this. So we hope you enjoy.
Equity Mates!
Alright, so today we've got Andrew Brown from E72 Holdings with us. So Andrew, thanks for joining us.
Thank you very much.
So this is actually our second interview with you. You're the first interview guest to come back on the pod, so congratulations for that milestone.
Excellent, thank you. We're honoured.
For our listeners who haven't heard the first interview with you, can you just tell us a little bit about yourself, your investing history, and what you're doing here at E72?
Yeah, sure. I started in 1980 as an investment analyst at the Prudential Assurance Company in London, which is the biggest life insurance company over there. I got given Australia to look at. From there, I progressed through stockbroking. I spent quite a number of years as an analyst for stockbroking firms, analysing banks and insurance companies. In 1994, I jumped back over the fence and became an institutional money manager again with AMP. Pretty topical. And from there, I moved to Rothschild, where I was the head of Australian equities for 5 and a bit years. And then after that, around about 2003, I've pretty much been doing my own thing, investing in smaller companies. E72, myself and my wife put some money into a moribund shell company. In other words, a company's got nothing in it, which is listed on the NSX, the National Stock Exchange of Australia, back in the middle of 2016. And so we've been running this for just a bit less than 2 years. And we invest basically globally, and we short sell indices and stocks, as well as obviously buying stocks, which means going long. And so we run what's called a hedge fund, where we go long and short. So yeah, that's what we've been doing the last couple of years, and we had a great first year. This year's been a bit trickier for the reasons which we'll explain later on.
Nice. Well, Alec and I are actually looking for a shell company, so if you know of any, let us know.
Thanks for the lithium boom. Shell companies are quite expensive. They're also getting, to be fair, they're getting less useful because particularly the Australian Stock Exchange have really clamped down on so-called shell dealing, where you have a moribund company that might have sort of made postage stamps or something exciting like that, and then a lithium explorer comes along and wants to put its business in. And certainly the rules around doing that are much tighter now than they've been in the past, and they're getting tighter still.
So, Andrew, the last 2 episodes that we did with you were our very first, as you said, Brands, and I think that the feedback we get from them is fantastic, just through your way of speaking, and your style of investing is very much in the way of, or the line of how Alec and I invest. So just, if our listeners haven't listened to it already, definitely go back and do so prior to listening to this one, because you gave a couple of stock tips at the end of the first.
Absolutely. We discussed quite a bit. I mean, the most explicit stock tip I think I gave you was to buy shares in PM Capital Global Opportunities Fund, which is listed on the ASX. It's a listed investment company that invests globally outside of Australia. It's a great example, actually, the way it's panned out as well, just in terms of real common sense. At the time, the shares were trading around about $1. And at the time, the shares had a net asset backing of about $1.16. So obviously, they were about a 15% discount to NTA. And this is NTA before tax, I'll stress. So the upshot is, if you bought them at $1 today, they're about $1.27.5. And they paid about 3.6 cents in dividends. So let's just break that down a little bit, because I think it's really instructive. The first reason the shares have gone up is the NTA is not $1.16 in a bit anymore; it's about $1.41.
Wow.
So the actual, return on the portfolio is over 20%. So PM Capital, PM stands for Paul Moore, who's the guy who runs it. So you had a return from the portfolio of about 21%. In addition to that, the second return you had is you had 3.6 cents in fully franked dividends, which they paid out, which is not too bad. And then finally, which is really interesting, because it's very much the way I try to invest, is the discount to net asset backing has closed up. Okay, it was about 17%. It's now about 10. Okay, so $1.27 versus $1.41 is about 10. So you've made a 7% return just from the discount to NTA closing up. And the reason it's closed up is because when we recommended them to you or suggested them to you, PM had a bit of a tricky run, but was starting to become good. And now they've had an excellent year over the last year, and so investors have got a lot more comfortable with PM in the long term, and so they've closed the discount up.
Mm. So far that's a hit rate of 100%.
100%.
So that's
and
up.
I should stress that was my most explicit recommendation.
And do you still own it?
Yes, I do. I absolutely still own it. The reason being is there's still an okay discount to the pre-tax NTA. There's no real discount to the post-tax, but I still like the composition of the portfolio, which actually hasn't changed that dramatically over the last year. It's still chock full of global banks, which are pretty cheap, and should do well in a rising interest rate environment. It's got a lot of European banks in there as well, which are actually much cheaper than the US counterparts, and they continue to rank. So, we did also, let's look at the other side of the equation. We spoke about McGrath, which is obviously the real estate agent in Australia. The stock rating is about 67. It's currently about 38. Why has that gone down? Quite a few reasons, actually. First of all, obviously the real estate listings market has come off the boil, and these guys obviously depend on volume, not so much price, in terms of the real estate listings business. But people still don't really understand the company. The key value driver in the company is actually its rental book. Okay, so it's this property management book where it manages properties for landlords. That income stream is much more valuable than the one-off income stream from just selling someone's property. The problem, of course, is that the income stream from a one-off sale of a property is quite big. The second reason is that obviously McGrath struggled to come to grips with being a public company as opposed to being a private company dominated by John McGrath. There's been a complete turnover of the board, who were largely installed at the time the company went public. And I think it's fair to say the executives and everybody else has really struggled with the whole public company thing, which is very interesting. That's something to keep in the back of your mind sometimes when we see a really good business and it's been private and done really well, and then it goes public and it just really flops around and struggles. And it's because the greater disclosure. And in the case of McGrath, it's the only listed real estate agent. So you can imagine what happens every time there's a McGrath announcement. The first bloke printing it off is the strategist at Ray White. Looking at the margins and everything else. The third issue, obviously, there was a lot of scurrilous publicity about the social habits of the founder, his predilection for horse race gambling. So that certainly didn't help, and the earnings have obviously gone backwards as a consequence of things. I still own them. I actually own more than I did then, more as they've come down, because I believe that the value of the company is basically taken up solely by its property management business, or the rent roll, as people call it, and I reckon I'm getting the rest of the company for not much.
So with McGrath, do you worry about the agents that have left?
Yes, I do. Obviously, I prefer that they haven't left. One of the things when companies have been private for so long and people have amassed some degree of wealth in the equity is that they sell it and move on, and they were nailed down for a period of time. And as soon as those handcuffs, if you will, were off, and the handcuffs were that their shares were what's called escrow, in other words, locked up and not available for sale. And as soon as the escrow finished, a lot of the agents, and they're quite high-profile agents in Sydney's eastern suburbs, Upton, where who founded their own little company called The Agency. I prefer they stay, but the key is McGrath's expanding outside of Sydney's eastern suburbs. So as time goes on, the sort of glitterati thing about it, and just the scurrilous gossip in a relatively small area, will start to be a bit less relevant.
Now, we should defend your pick, though. You did say on the last podcast a 2 to 5 year time horizon,
absolutely,
and only a year's passed. So
only a year's passed. So it's like, one of the things I think I tried to stress is patience. That you're not going to buy stuff at the bottom, and then just watch it go up unless you're extremely lucky or have information you shouldn't. And certainly, often time involves just waiting. If I can give you a spectacular example, which we didn't mention, but has gone bananas, and many of your younger listeners will be very, very familiar with this company, which is Kogan. Kogan had been floating for over a year. It floated at $1.80, it went down as low as $1.30. And the company was doing absolutely nothing wrong in terms of building out what it said it was going to do, the way it used its money, the way its profits were coming along. It had 5 profit upgrades. And the shares were still below the $1.80 float price after, I think it was about 15 months roughly. And we got to about June of last year, and Kogan really started doing some very, very interesting deals in the telephony space, particularly with, as a big reseller of Vodafone, and under the Kogan mobile brand. And that really started to get traction because the price discounts were tremendous. And of course, they were able to do great things like package it up with a phone. And as you all know, the market's changed, whereby you don't buy a phone on 24-month instalments from Telstra. That's a lot of money. You buy a phone outright and then you can switch around. And Kogan were offering some brilliant deals. And people didn't understand the company. They thought it was going to get swamped by Amazon. And as late as June of last year, the stock was $1.65. They did 1 or 2 presentations, and people started to get the message. And of course, the stock since then has been to $10.
Yeah.
So it was hopelessly cheap for 15 to 18 months, and then in the space of 4 or 5 months, basically went up 5-fold.
do you think it's beyond its valuation now?
I think it's a bit expensive at the moment. Yeah, absolutely. I had some Kogan, and I sold out certainly not at $10, but I made great money out of it.
Yeah.
But it's a bit expensive for me at the moment. I think it's kind of it's discounting things a bit too far into the future.
Yeah.
But people misunderstood the management as well. They didn't actually go along and get to meet the management, get to know the management. And when you do that, yes, they're controversial. Yes, they turn up in hoodies and jeans, but they know where every dollar in the company is. And people didn't understand the technology, the algorithms, the global nature of the business. You've got people in Eastern Europe bidding product into Kogan, at low prices, so that they can pass that on to you. And people just didn't understand how good a company it was. I think they thought it was just buying cheap stuff from China and flogging it on, which is a complete misunderstanding.
Mm.
I think we also talk about the other spectrum. Last time we spoke about basically old style media.
Yes.
And we touched on 3 or 4 companies. We touched on News Corporation. At the time, they were about $17.80. They're currently about just over $21, so they're up 18%. That's really on the back of the continued increasing price of their subsidiary, which is REA Group or realestate.com. But they've also started to get to grips with some of the problems they're having. Foxtel obviously is not what it used to be, so they're starting to cut costs and do things there and try and improve things. So that's been pretty good. Just to contextualise for people, just in the periods of time we've been speaking from roughly about a year ago, the Australian stock market's up about 3%. If you include dividends on top of that, it's up about 9%. Okay, and the S&P 500 in the US is up just under 16%. Okay, so it's obviously one of the top markets around the world. So News Corp's done pretty well. We also touched on Nine Entertainment Group, which owns Channel 9. And at the time, I think the stock was about $1.10. It's now $2.30. Why is that? Really 2 or 3 reasons. First of all, it's too cheap at $1.10 anyway. The cash flow was being valued about, or the cash flow cover generates, and I'll talk about this later and how you look at that, was being valued about 5 times cash flow, and that multiple has expanded out. Secondly, their pre-tax, pre-interest cash flow at the time was about $200 million a year. It's now about $250 million a year. How come? Certainly a chunk of that is the fact they now don't have to pay about $25 to $30 million a year in licence fees to the government, so they've got a one-off kick from that. But also, as you'd probably be aware, their ratings have been going up. Thanks to that wonderful letter acronym, MATS. So they've been catching up with Channel 7. They've been garnering an increasing share of the ad market, not necessarily from Channel 7. It's all been coming from Channel 10.
Yeah.
So that's been good. And of course, the rating of the shares has gone up as well. So that's why the shares have effectively doubled on roughly a 20% increase in cash flow. The other one was Fairfax. They're actually, funnily enough, about where they were a year ago. That sounds a bit funny. A year ago, they were about $1.02. They're now about 74 cents. But of course, in the meantime, you've also got a tenth of a share in Domain. And Domain obviously owns the property portal of the same name. So you had one Fairfax at 74 cents and 1/10 of the Domain, which, as we're speaking, is about $3.20, so 32 cents. And altogether you got $1.06 and you got a bit of dividend. So the Domain float was sensible, but the sort of oil line assets have been derated a bit since that float. So it's looking a bit more interesting at these kind of prices, but I don't know any we also touched on Apple.
Yes.
Apple's up 34% roughly from 140 to 187.
Yeah.
That's despite the fact they're selling less phones now than they were a year ago. They put the price of them up quite appreciably, which you can do some simple arithmetic with the Apple quarterly reports and discover that. And really what Apple's turned into is pretty much a capital management machine now. So they're $280 billion of cash. Don't forget, they've got $100 billion of debt. They also got to pay $38 billion in tax as they bring their money from overseas tax havens back to the US, and they also owe the year about $13 billion as well. But they've had quite aggressive share buyback programs, and in fact, have really re-emphasised that recently. So what's going on is that in fact, the profitability of Apple's flatlining and will probably start to go down, but they're using the strong cash flow they have to actually buy back shares. And they're tending to be very price insensitive, as a lot of those large American growth companies are. They're quite insensitive about the price they buy shares back at, which I find a bit bizarre. But so Apple, in a sense, we got the sort of we got part of the analysis right, but certainly the share prices outstripped my expectations.
So, do you still think it's overvalued? Are you still short?
Yes. Yeah. Not massively so, but certainly I still think it's overpriced. Yeah. I mean, how can else best?
That was my follow-up question. Yeah.
He's investing. I mean, basically, the risk with Apple is that basically they don't catch the next wave of smartphones, whatever they are, and it's worth remembering as well. The smartphone market is now mature. If you don't believe me, if you look at the Gartner figures, they're one of those big IT consultancies. In the fourth quarter of 2017, smartphone sales were actually below where they were in the fourth quarter of 2016, and the rolling 12-month growth in the fourth quarter of 2017 was only 2% across the world in smartphones. And of course, now you've got a whole bunch of differentiated price point manufacturers whose product is pretty much of a muchness, really. You can't really say Samsung's massively inferior to Apple. I appreciate people who've got brand loyalty. Amazingly so in the case of Apple, which they're now being, they're being punished for that brand loyalty with ever-increasing price points. So, you've now got 2 or 3 really credible Chinese manufacturers at much lower price points, as well as Samsung, of course, and others. So I tend to think that, with that maturity in the market, I think Apple's ability to keep prices up is going to erode, and that starts to get a bit more interesting.
Yeah. So, do you think their push into services will do much to save?
Well, it's done that already. I mean, services is a bit of a business that's growing, and a company that in overall profit terms is not growing.
Yeah.
But don't forget services as well. I mean, one of the issues with Apple is it's a closed loop. There are many, many other service companies that are doing the same thing. They're actually much better. Dropbox is recently listed. There are various other Dropbox-like companies, but not as good. And then, of course, you've got Google. The issue is that cloud storage, if you will. Whether you or I personally, I acknowledge that backing up to iCloud is very easy if you have a Mac. But if you don't have a Mac, then it's irrelevant to you. And you've got a multitude of others, whether it's the Google or a Dropbox or something even more sophisticated.
Yeah.
So there you go.
Nice. Well, Andrew, part of what we wanted to discuss tonight was information and staying on top of information.
Yes.
Looking around your room right now, you've got 4 monitors, a bucket load of books, and about 200 plastic sleeve folders with what looks like all the types of companies that you're investing in, or at least keeping an eye on.
That's right.
And so one thing that we want to try and understand is the habits that expert investors have when it comes to understanding how you read and staying on top of things. Yeah, so I guess the first question is, given there's so much information out there and so many sources, you've got 4 monitors going on, what are your go-to sources of information, I guess, free, and also do you pay?
This is changing. I mean, it's a particularly interesting question right now. Many of your listeners may or may not have heard of 5 horrible letters, MiFID. MiFID stands for Markets in Financial Instruments Directive. And it's not just MiFID, it's MiFID 2. So it's the second one of these. And as you probably gathered, that could have emanated from only one place. And yes, you're absolutely right, the European Union. The biggest bureaucracy in the world. The issue with MiFID is basically stockbrokers, so people that you might ring up or deal with, in securities. Basically, most of the big broking firms around the world, the UBS is the Goldman Sachs, the Morgan Stanleys. They obviously will execute share transactions for you or any other transaction, but also, of course, they offer research. And the idea is if you're a client, you basically get the research for free. Okay, and what's happened is the EU basically said you can't do that anymore because of conflict of interest. So you've got to break down effectively the three things that a major house like that will offer, which is on-market transactions, research, and corporate offerings like IPOs or secondary trades or whatever. Okay, and so they want that broken down. So what's happening is in fact, research is getting priced. And so in a few years' time, because it's only really just started and hasn't developed yet, there is the chance for your folks to actually buy research from a Goldman Sachs or a Morgan Stanley. At the moment, it's way too expensive. Okay, I largely get that for nothing because of all the transactions that I do through an intermediary platform. Okay, but in due course, you'll be able to get that for payment. At the moment, the free sources I get, the most obvious free source is the company itself. Big companies, and particularly companies outside of Australia, tend to have very good investor relations departments. They're obviously obligated by securities laws to keep you up to date with absolutely everything. Particularly if you're looking at US companies, I mean, the sheer quantum of filings is unbelievable, and the kind of information you can dredge out of that, and the kind of homework you can do for yourself is good. It's the same in Australia, in fairness. It's done in a different way, but Australian companies tend to be quite disclosive, because they're using the same accounting standards as every other company. So there's the company itself, there's obviously the press, the media. That's all free. I do increasingly use things like Twitter. Twitter is fabulous because you regulate what you want to see. So if you don't want to see Kim Kardashian, that's fine. Like it. And so I don't know Kim Kardashian on my feed, but I've got absolutely oodles of people that discuss securities. In all kinds of different ways, from extremely speculative Australian mining stocks, up to people discussing what the meaning of Warren Buffett scratching his nose is. So it's that kind of stuff's great, and you find more and more people because of the network effect that Twitter has. I do have some free bulletin boards that I go on, which are usually outside of Australia, in the US and one in particular in Canada. I do pay for subscriptions to the Wall Street Journal and the Financial Times, so I can keep abreast of sort of broad news, if you will, and things like that. And then outside of that, it depends if you've got a security that's in a particular industry. Do you then go beyond that and actually buy a trade? I'll call it publication, but they're all online these days. So I actually keep fairly well abreast of the shipping industry. At the moment, because most of the securities in the shipping world are actually very, very cheap. And so I'm really interested in what's going on with freight rates for containers and daily hire rates for very large crude carriers, which are oil tankers and things like that. Changing and improving and stuff. So you've got to look around. I mean, it's up to you to just go ferreting, to be quite honest, but it's a lot easier to do that.
So can I just ask, with your media subscriptions, you said Wall Street Journal and Financial Times, but not Australian Financial Review? Yeah, I do. I do read the Fin Review. Okay. That's been, I think, the Fin's actually been extremely good in the last year. I mean, they've really unravelled two or three companies on the Australian market that haven't done the right thing by investors, in my opinion. One of which is a big one, which obviously is now going into receivership. But I had a short position in Blue Sky Alternative Investments, which went all the way from sort of $2 on to 14 and all the way back to 2. Thanks to the research report with Not Sure, which kind of people, my logic is very much the same as the short seller's logic. So that was, the Fin Review did a lot of work as well.
putting that out. So the thing's actually pretty good. In terms of Australia, but elsewhere in Australia, I mean, you really know you need to get broker research just to get on top of things, and you can get that, by one means or other. Other than that, as I say, I think it's there's so much stuff now that's free though, and please don't ignore the stuff overseas. I mean, because you've got an Australian company in the US, there's going to be a peer company in the US, so when they report their quarterly, it's going to have some relevance perhaps for the Australian company you've got an interest in. So things like that.
So, based on all the information that's out there, all the information you can get, you've only got so much time in the day.
Yep.
So, what does a typical day look like here at East 72? Like, how do you sift through all that information?
Okay. Basically, what I try to do is, like anybody else, try to really plan the day. That tends to be based around the fact that if I know one of the investee companies is reporting, obviously I'll take an interest in that report, so I might listen to the webcast, might phone in to the teleconference, may ask questions, may not. And don't forget, that's globally as well. Okay, so, I might go home, and in Europe, there'll be teleconferences on at 5 in the evening Australian time at the moment. The US obviously tends to be later at night our time, but a lot of companies report before the market opens. So that's kind of 10 o'clock at night, so I might tune into those and, go through them. So I try to obviously keep on top of what's going to happen, a week ahead or 2 weeks ahead, what companies are reporting, that's going to be relevant to me, either things I'm looking at or alternatively, obviously, particularly stocks that I already own, or, of course, stocks that I've got a short position in as well. That's quite important. So I just try to plan things out. And then, where I've got what we might call a spare day, it's a matter of just, there are companies that you want to have a look at that you've been thinking about for a little while for whatever reason. We'll come on to, why you might think about a company. But you just sit down and start going through those, which might involve building a spreadsheet model, just doing some, cool research on the thing and trying to build up an investment thesis around it, which I think, is one thing I really encourage you, your listeners to do, is if you're going to invest in something or even short sell something, there's got to be a rationale behind it. And increasingly we call these things investment thesis, because there's a thesis about why you're buying it.
Yep.
Okay? And it's going up is not a thesis.
So then I guess the flip side of that is are there any sources of information that you don't think add a lot of value or that you don't pay attention to?
Yeah, I mean, funnily enough, despite the fact I get heaps of them, I mean, some broker research is, and they just rehash what the company says, for whatever, sometimes there's corporate reasons for that, they don't want to upset the company and things like that. So, I'm not disparaging all broker research by any stretch of the imagination. There's some exceptional people that write it. That is changing a little bit because of MiFID too. But certainly broker research is not as good, is not always that good. And certainly I ignore the recommendations completely.
Yeah.
There's, you get very few sell recommendations in broker, which means it's actually, if someone does say sell, it's actually worth having a really good look at it, and actually analyse why. But, it's the research itself. It's kind of, constructing and understanding something that's written why you think they're wrong.
Yeah.
Why are they wrong? Why are they right? So broker research is not always cracked up to be. I certainly ignore speculative bulletin boards. They're just for people that, we've got one particular one in Australia, which is, I can't believe actually exists under the regulations, which is hot copper. And there's a whole lot of people, basically just push stocks on there and, try and ramp stocks up that they've got. So, it's a lot more interesting. I mean, I find the debate on Twitter, for example, is much more highbrow. People actually give you good information. The other source of information, which is increasingly available, is hedge fund newsletters. And giving a big source away here. Hedge fund newsletters. You go to Reddit. Okay, there's a subreddit on Reddit called Security Analysis. And as part of that, there's always each quarter there's a component that's hived off there called hedge fund letters. Okay, and there's literally just a great big list of 50 or 60 hedge fund letters. And I mean, these are the smartest people in the business, or supposed to be at least. And they often, of course, they often write about a couple of stocks that they own. They write about the thesis behind them. They obviously own them, so let's make that abundantly clear. And they're writing about some of the shares to go up in price. But but some people, some of the letters are just stunning. You really do realise how smart some of these people are. So once you've now ferreted around and gone to Reddit and done the security analysis and done the hedge fund letters, there are 3 or 4 I'd really recommend are very, very well worth reading. One is called Horizon Kinetics. They write a lot of general stuff about markets as well as individual securities. Another one is called Green Hill Road. That's a guy called Scott Miller in the US. He's got a pretty small fund, but he's done very, very well. The way he writes about stocks is really super easy to read. There's another mob who are called Greenwood. They wrote and released free a very, very long research piece on TripAdvisor last year, which turned out to be pretty prescient and pretty good stuff. I happen to like their style. Those guys all tend to be sort of value type investors rather than growth type investors. Okay, but equally, of course, you can find a heap of hedge fund leaders which have got growth investors who tell you Amazon's still so cheap and so fun. Okay, and so, horses for courses. You'll find some people there that maybe don't work for me, but they might work for you. But, go, just read that stuff. It's interesting. And of course, you get the explanation of why these people own these stocks. Okay, and so you're going to develop your thinking as to why you should own not that stock, but just any other stock. And develop. Hey, this is a thesis. This is what they're saying about why. And so read those things because they're really instructive and they're free.
That's great. I tried to do something similar by signing up to all of their mailing lists, and now my inbox is just overloaded with too much stuff to ever read.
Absolutely. What you find at the end of the day is when you find people that you can relate to, albeit across a piece of paper, and so you gravitate towards that sort of stuff. It's simple as that. Because don't forget, what this cape is all about, it's about developing your own investment style. My style is pretty conservative, it's very, very value driven. I tend to buy more boring, lower growth stocks cheaply. Whereas other people obviously, are trying to find the next Amazon or the next Spotify or the next whatever, and that doesn't necessarily fit with me that well, although I have owned Twitter in the past and made money out of it. So,
you don't anymore?
No, not at this level.
When the shareholder?
I think similar to what you're saying about
fundamentally misunderstood component of social media, and certainly a year ago when it stopped about $6 million on a per active user basis, it was a fraction of the price of Facebook. But it was also a fraction of the price of a completely useless platform for social media, which is Snapchat. Twitter is, the more you use Twitter, the more you, in many ways, the more you get out of it. And as I say, it's whatever you want it to be. And that's why it's actually a really, really useful investment tool.
And similar to how you were saying that the conversations around investing are so good on Twitter. Every subculture, every interest group is Twitter is that congregation point where information is disseminated.
Well, to give you an idea on Twitter, I mean, there would have been 10 people on Twitter tweeting about Blue Sky once the Glaucus report came out, and there is quite clearly, effectively, a pooling of information that people added to the Glaucus report. People who've done their own research and have been sat there frustrated as hell that the shares have carried on going up when they knew they were just silly. And the amount of information that got pooled effectively between people on Twitter about the whole thing, was very good and very reinforcing to the thesis that the company was structurally overvalued. opaque in its disclosure, didn't have $4 billion of real funds under management, didn't disclose properly transaction fees, and was carrying assets in some of its funds that were flagrantly over.
Were you one of the people tweeting?
Yeah, absolutely. Yeah, totally.
Yeah.
Totally. We met when I was trying to ask questions in the teleconferences. I didn't get a look.
So, Andrew, you were speaking about the hedge fund letters as a means of understanding the why.
Yeah.
And so the main purpose of today's discussion with you, that was a very brief introduction into you.
Yes.
So the main reason that we got you back on the show was something that we haven't done on the show before with any of our guests, and that is actually dive into your way of looking at end-to-end a stock and how you come to value it. We're not expecting you to come to a dollar figure at all, but what we want to do is get an end-to-end process of idea of how you identify a stock all the way through to hitting the buy button.
Okay.
So last time we
what I'd love to do, and people might just want to get a pen and a bit of paper, before we get into the particular company, I just want to maybe explain to people some really simple concepts, okay? And I want to do that using the example of owning a house, which you rent out, okay? And it just is going to make what we say a whole lot easier to understand.
Sure.
So you might just want to, so if you're listening, you might want to make just a little few notes here, and it'll just make everything else really easy. And the notes will give you a reference point for the future when you go look at a company. So let's say you buy $1 million house, which of course in Sydney means you'd be about 60 k's from the city. So let's say you buy $1 million house and you've got $300,000 of equity, and you borrow $700,000 from the bank, which fudges all your financials. Okay, and so you've got $1 million. Let's say within the house there's $70,000 worth of fittings. Okay, so kitchen fittings, bathroom fittings, all that sort of stuff. And you rent the house out for $40,000 a year. So you're getting a rental yield of 4%, okay, on the house value, which of course means it cannot possibly be in Sydney. The average rental yield in Sydney is 3.75, and in the eastern suburbs about 2.
Wow.
Okay. Now, let's also assume that your cost of money is 5%. Okay, we're not going to worry about tax too much on this either. Okay, so first of all, so we've got $1 million house, and you rent it out for 40 grand. So you get 40 grand a year. The real estate agent, which we hope is McGrath, takes a 6% fee. So that's $2,400. So your top line profit, if you will, is $37,600. Okay. Now, if you think about it, that is your earnings from the house before interest charges, because remember you borrowed 700 grand, or tax, or depreciation, because the fittings will depreciate. Now, there's no amortisation in this. That's an asset you bought which you have to discount the value of over a period of time. So now you're going to see the word, every security you look at, you're going to see this acronym EBITDA. Okay? Earnings before interest, tax, depreciation, and amortisation. And the reason why you see it, it is a proxy for pre-tax, pre-interest cash flow. And I'm going to show you how they marry up when we look at our stock. Okay? So your EBITDA is $37,600. Your depreciation will say is 10%, so every year you can write off 7 grand. So your earnings before interest and tax is 30 grand, 30,600, and 37,600 minus 7,000. However, your interest cost, of course, is 5% of $700,000, which is $35,000 a year in interest you're paying to the bank. We'll assume it's interest only. So you're actually going to make a pre-tax loss of $4,400. Okay. However, your cash flow is $37,600 minus how much you sent to the bank, which is $35,000. So you've actually got cash flow before you have to spend on upkeep of $2,600. Okay. However, if your upkeep costs $5,000 a year, you've got to be putting in money, obviously. So if it's $5,000 a year of upkeep, then you'll be out of pocket to the tune of about $2,400. Now, let's get a couple of other concepts out of the way as well, and you'll see why I use this example. The $300,000 of equity you put in, that is the equity capitalisation of this house. Okay. When you add the $700,000 of debt to it, okay, that is what is called, in a company context, the enterprise value. Okay, so if you took over that house, okay, you're basically, if the house was in a little company and you took over the company, effectively the company wasn't just going to cost you the $300,000 of equity, you are going to have to absorb the $700,000 of debt. And of course what people do is they often relate cash flow to the entire enterprise value of the company, because that's the relevant bit. Okay? If you were to buy every share in the company, what Warren Buffett talks about, look at these things as businesses, not bits of paper. Okay? If you were to buy every share in the company, that's effectively what it would cost you. Only $300,000 for the equity, but you'd have a $700,000 debt that you've absorbed as well. Okay? So I want to get those concepts across. So the equity value, $300,000 in the case of our house, the enterprise value, which for our house is $1 million, EBITDA, which we established in the case of our house is rent minus the real estate fee, $37,600, EBIT, $30,600, which is EBITDA minus depreciation, and then obviously the interest charge. Okay? So you could argue if this house was a company, it's probably not worth very much because it's not actually producing an after-tax profit at all.
No.
In fact, it's not even producing an after-tax cash flow because you've got to keep putting money in it.
Yeah.
Okay? So you can probably start to see, it's not a particularly great deal. And in fact, the pre-tax, pre-interest cash flow of $37,600 is only a 3.76% return on $1 million. So it's pretty crap.
Yeah.
Okay. I should give a disclosure here that I actually own no real estate anywhere in the world. So, yeah.
Fair enough.
Yeah.
Well, we might just tell our listeners, we'll put that in a blog post to go with this episode release.
Absolutely.
So if they didn't write that all down, they can go to equitymates.com/blog and we'll have that explained with this episode.
And use that because if you start coming to companies, I mean, it may sound very simplistic what I'm giving you, but you might find it's actually quite effective to help you understand the various concepts that go into looking at a company without you having to do an accounting genius.
Yeah.
So, okay. You are going to need to be an accounting genius in the next 12 months because all the accounting rules are changing. Particularly, you're going to hear AASB 15, which is Australian Accounting Standards Board 15, which is going to change the way revenue is accounted for.
Okay.
It's going to spread revenue out over a longer period of time. And AASB 16, which anybody involved in a major retailer is going to hate because it's going to bring all those shop fronts on balance sheets. Yeah. Leases for all the supermarkets and whatever, they're actually not on balance sheet at the moment, but they're going to be brought on balance sheet. Yeah. So, Woolworths' debt is going to look horrendous.
Yeah. Okay. We both work for major retailers, so
very, very well. Yeah. This is going to change the return concept quite a bit. So just beware, things are going to get a bit complicated. Okay, so right.
Okay, so that was
an intro to an intro.
Yeah. No, I think that was a good summary of some of the main concepts that now we're going to sort of apply to your process.
Absolutely.
Thanks for listening, Equity Mates, and sorry for the poor audio. We tried to do the best we could to clean it up, but we know it still wasn't great. We hope the content and Andrew Brown's insights more than made up for the poor quality audio. Tune in next week, or next episode even, to listen to Andrew Brown apply some of the concepts he just spoke about to a stock that he's currently looking at.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Minds.